Good morning, SMF Street. Monday morning, if everyone remembers what Monday morning sell was and how that long list of red was, this is called a counter trend to that selling Monday. And it starts in the futures market, just like the sell side started where we had all red on the NYSE. Today we've got a very long list of gaps across the board with some, and this is all volatility when there's a major change that's going to occur in the next month or so. There's a major disconnect between the futures market and the actual valuation. A lot of it is earnings volatility. We said the earnings weren't going to be all that bad across the board. This is part of that gap. We are hitting record highs in oil today. I believe that we will be breaking those highs. I also believe that it's a perfect opportunity. It's a light week. It's a Jewish holiday week. A lot of the bigger players are not there. That's when they create these counter gaps. And they're using the futures, are all artificial prices that are higher from the previous day's close is what it means. Now, on the gap open down list on the NYSE, you got IBM that reported a record quarter, but it's down $1.60. Okay? So you got a diminishing gap down, and the majority of the crowd is to bring the people into the names. They buy the high prices, just like we seen yesterday. They sold every one of these gaps down. Now, the bull will get very excited about the earnings, and it's great. We've had 9 good quarters, including this quarter so far, of good earnings. But those days are gone. Those days are gone. Those earnings are going to contract between now and the end of 2011 and 2012. Some of that low, cheap dollar, which has created commodity-related stocks and energy-related stocks to go higher, like the FCXs here, like the oil or the gold trade, the silver trade. All of these things give signals that there's a major change coming. And it's always been like this throughout my career at various times between the bear and the bull. Okay? So that big, huge selling on Monday, and today is Wednesday. Like I said, you would get a counter gap in the pre-market futures, and that's exactly what you're seeing on the NYSE, where 60% of their program trading goes. So what market makers do is we let them put in the high, and when the buyer isn't there, we sell short down. When they come down, the bull's exuberance is going to still be there, and they're going to get sucked in up at these highs. And they're going to end up having a really bad thing between now and end of year and going through the summer. And as we wind down with these earnings this week and next week, there isn't going to be any catalyst to keep these up here. So we're going to be looking at this market is extremely overbought to start with. That's part of what Monday was. It wasn't so much about the downgrade of the debt. It's just that this market has been so overbought on a weekly level and a monthly level that it's going to take a lot of money to keep this thing going. So the difference is buy side during the actual trading day is where the buyer and seller are meeting. In pre-market, these are just artificial prices that are being pumped in the futures market. And then they have a tendency to come tumbling down.